Okay, that sounds good. Listen, first of all, thanks for having me. It's a real treat to speak today. And our subject is how to turn every Friday into $1,000 payday by risking just 1,500. So, if you're a big time options trader and you like to buy breakouts and do a lot of leverage, you might say, hey, what are you talking about? I like to double my money, triple my money, whatever. But so here's the caveat down here right below in the golden writing, all while having an 80 to 90% chance of winning. So that's kind of the key to this whole thing. So let me introduce myself. My name is Peter Schultz. I'm the president of Cashflow Heaven Publishing. We specialize in cash flow strategies. And I'm also the chief strategist for the Winning Secret, which is the strategy we're going to talk about today. And so just to elaborate a little bit more on that probability, I love these little memes on the internet where they say keep calm and do something. So this is keep calm and estimate the probability. And here's what I noticed about myself, and see if this doesn't sound familiar with yourself. So when I first started trading options, I saw the amount of leverage, and I saw how a really cheap option could turn, it could double, triple, quadruple. And I thought, my gosh, this is the holy grail. My only problem in life is going to be what color my Mercedes-Benz is going to be. And then I started trading, and if you've ever noticed kind of a strange thing happens on your way to deposit in your $1 million at the bank, the stock reverses, it stalls out. The Federal Reserve comes out and makes some comment nobody likes. And your fantastic chart, your great trade setup, this thing that you absolutely knew was going to make you a fortune, reverses, and you lose your money. And for me, maybe I'm a little bit of a slow learner, but that went on for several years, and I just got tired of it. I got tired of funding this account where everything was going to work out, and sometimes they did. You hit a couple of home runs and you got real excited, but then you ended up losing money. And so, hold on one second. So I finally came to this revelation, and I jumped on the other side of that, and so I started selling spreads. Now, I know you just saw a big presentation on spreads. You probably heard a lot about credit spreads. Maybe you've done them a little bit yourself. So what I'm going to ask you to do is just stick with me just for a little bit and see if you can't learn some new things about spreads. Maybe they're going to be a lot more exciting than you think they are. And maybe you're going to see some ways to make money and really increase your probabilities of winning that you didn't know before. And if we can just do that, I'll consider this whole presentation a great big success. So when it comes to stacking the probabilities on your side, there's no strategy in existence that gives you a better chance of winning than selling credit spreads. So once again, the difference between the pros and the amateurs is the amateurs think about how much money they can make on a trade. Very, very exciting. And the pros think about their probability of winning. And what happens if they don't? Very, very good questions that come with experience. So credit spreads are a lot different than any other type of trading. With credit spreads, you don't have to pick where a stock is going to go, just where it's not going to go, and that's a whole lot easier. So here's a chart of the biotech index a little while back. This chart isn't necessarily current, but it's here to give you an illustration of what we're talking about. So some really basic chart reading shows a very strong upward trend line that the IBB is broken off of a couple of times, and then it breaks that trend line on pretty big volume. And that tells us something's gone wrong. Something's wrong with this sector right now, and it is probably going to fall for a while. Now, sometimes you'll see a little reversal, and it comes back up to touch this trend line, and then it just reverses right off of it and sinks again. So our strategy is to sell, and I'm just going to grab my little pen here so we can make some notes. And let's see, let's choose red. So what we're going to do is we're going to sell a call here. Whoops. We're going to sell a call here, and we are going to buy a call here. Now, you're probably familiar with this, but as you know, the closer call that you sell is more valuable than the one that you are buying, so it creates an instant credit in your account. The other thing I really love about credit spreads is you always have this finish line right here. You know when the trade's going to be over. And that solves the biggest problem most traders have, is when to get out of a trade. And when you sell an expiration date, especially one that's not too far off, that decision all gets taken care of for you. It's all automatic. So when you sell below a resistance line and you're selling call spreads, you have a very, very good chance of it turning out in your favor. And the inverse is true for selling puts. So, you know, these trades, they just tend to work out the majority of the time. And let me just get rid of my drawings and we'll move on here. Okay. So maybe close only worked before with horseshoes and hand grenades, but as you can see, now you can add one more to that list because with credit spreads, close is good enough. So on the last trade we looked at, it could bobble around. It could go back against us a little bit and we would still win on it. You get a lot of leeway. You get a lot of slack. So another way to look at this is there's 5 things and only 5 things that a stock can do. It can, and let's say that this stock peaked right here. It peaked right here again. We saw a gap down here, and we just figured that this stock is just getting ready to roll over again. And so we decide, okay, what we're going to do is we're going to sell a call spread, and let's say we sell it right up here. And we give it a little bit of time so we can collect some premium, but not too much. And let's just take a look at all the different ways these trades can turn out. Now, I just want to point out that conversely, if you were to buy a call on this, you think that there's going to be a big rebound, there's only one way you're going to make money on this, and that is to get the direction and the timing perfect. And that means it has to go up dramatically. So we're on the other side of this trade. We're selling that call, and we're buying this call to hedge. So there's only 5 things that a stock can do. It can go up dramatically. It can just shoot straight up. It can go up kind of. It can just kind of fade up a little bit. It can go sideways, as stocks often do. It can just bobble along a little bit up and down, and it can go sideways. Or it can fall slightly. It can go down a little bit. Or it can fall dramatically. It can drop like a rock. So if we sell this call spread up here, we have an opportunity to make money on 4 out of those 5 scenarios. I mean, just some real quick basic math tells us that that's an 80% chance of winning, and we get that on every trade. So just going into the trade initially to have an 80% chance of winning, you know, really puts the probabilities in your favor right off the bat. And this really doesn't depend on whether or not you're a fantastic trader, whether you're super intelligent, whether you know all the people down on the CBOE. You know, it's not dependent on all those external factors or having some incredible talent or timing ability. You can actually set yourself up. I'm going to show you exactly how to determine your probability. So all that has to happen to make maximum profits on a credit spread is for it to go to its expiration date without having exceeded your sold strike. So that's a pretty low bar to win. So right now, if you're winning on some of your trades and you're losing on a lot of your trades, just think about reversing that. Imagine what it might be like to win on the vast majority of your trades and lose on very few of them. So when you sell an out-of-the-money option, what you're really selling is time, and time has value. As that time runs out, so does its value. So here's a trade that we did. This is an actual one right here. And so this is a $2.50 spread. As you can see, it's a call spread. We sold it above resistance with the stock or the index in a downtrend. So with 9 calendar days left until expiration, we sold this spread for a 45-cent credit. So 45 cents divided into 205 is, you know, 22% or something like that. It's a pretty decent return for just 9 calendar days of time. But with just 7 days of time left, the spread was already down to 17 cents because we sold it when it kind of popped up here, and then it kind of went down and it waffled along here. A lot of the volatility went out of the options. And so in just 2 days on a $9 spread, in just 2 days, the spread lost 62% of its value. That means 62% of its value just melted into our brokerage account. We can close that spread right now. So one of the reasons a lot of people don't do spreads is they go, I don't want to be locked in for 2 weeks. I don't want to be locked in for a month. You know, I want to be able to get out when I want to get out. I want to be able to get out when the timing is right. This gives you the perfect opportunity to do that. The difference is every passing day is in your favor instead of being against you. So you've really taken one of the biggest constants in options trading, and that is time decay. and put it in your favor instead of it having working against you every single day. So, it's funny, back when I used to buy calls, I used to tell people, boy, if you want time to go by fast, if time's going by a little slow for you, just buy a call with an expiration coming up, and that future will be looming very large in your windshield very quickly. So, you take the aspects of options, what makes options tick, what give them value, and you take those major, things that determine value, and you put them in your favor. And that's just a huge key to winning. So let's just talk about that for a second. Let's define those. So there are really three main factors that determine an option's value. Number one is time. And, if you want to take a few notes in here, I think just not too many, but there's a few places where I'm going to tell you to take notes, and it'll really help you out. So the first one is time. That's simply days until expiration. How much time does the option have on it? Number two is how close the strike is to the stock price. So is the option out of the money? Is it at the money? Is it in the money? And that really determines the value of that option. And as the underlying moves, it very greatly influences the value of the option. So number three is, and this is a huge one, this is how volatile is the stock? How much does it move? So let's take a look at all three, and if we can take these major main components of what creates the value in an option and put them in our favor, we can go just hugely towards stacking the deck in our favor. And that's really the key with trading in general, is putting the probabilities on your side. So let's take a look. So let's take a look at the time remaining. So one of the most important things that I want you to get out of this chart of time decay is that at 4 months out, going into 3 months, you have kind of a flat amount of time decay here. It goes down a little bit, but not a lot. As you can see, from 3 months out till 2 months out, it flattens out a little bit. Now, here's what's interesting. The second month out, it's still, pretty flat, but it's starting to steep up a little bit. And then there's this magic point right here when the option is getting ready to be front month. It's just a couple days away from front month where that time decay curve starts to steepen up quite a bit. But here's the most interesting thing about this time decay curve. Right before expiration, this last 30 days is the steepest of all. And it gets steeper and steeper and steeper till that time decay is almost going straight down until you have zero time value left at expiration. So the main takeaway that I want you to get from this screen right here is that time does not decay in a straight line. It goes down kind of almost really exponentially. It goes down quicker and quicker the closer you get to expiration. So keep that in your mind. So the other interesting thing is options used to expire just once per month on the third Friday of the month. But the Options Clearing Corporation and the SEC made some big changes to options in the spring of 2012 when they allowed weeklies on certain stocks and indices to have expirations on every Friday of the month. So that's done two things. It's given us two huge advantages. Number one, we can now sell an expiration for every Friday of the year if we want to. So that's 52 paydays per year. That's a lot of cash coming in. And considering the fact that it's pretty worry-free, pretty hands-free, you're not hovering over your computer, you're not, you don't have your quivering hand on the mouse wondering when the exact perfect time to exit this trade is. And, oh gosh, my timing was off. Oh my, no, I lost all my money. The thing dropped right out from underneath me. It doesn't work like that. Time just every day goes by. The closer you get to expiration, the more that time decay is accelerating. And about 8-9 times out of 10, it just expires in your favor. And I'm going to show you real quickly how to handle the time that it doesn't. But let's move on with our second reason. So number two is which means we can sell on the perfect point of the time decay curve. So remember that time decay curve where it was really accelerating in that last little bit until expiration? Well, you don't want to sell too close or you don't get enough really time value. And you don't want to sell too far away or you're not on the right part of the time decay curve. So after a lot of research, here's what we've determined. This is another area that you can write down. The perfect amount of time to sell is 1.5 weeks. We're typically 9 or 10 days to 2.5 weeks of time. And a lot of that will depend on how volatile the market is. If the market is fairly volatile, and the options are fairly expensive, you're going to be selling closer to this 1.5 weeks because you can get a lot more money. If the market is kind of flat and premiums are not very high, you're going to be selling a lot closer to this 2.5 week period. But right in here is this perfect time. And in the context of this entire curve right here, look at how steep it is on the amount of time you're going to be selling. So once again, this is another little spot to write down here. This is really valuable information. Sell an amount of time where you get a pretty good premium. You can still be quite a ways from the underlying, so you're giving it some room to move. And you're actually on the steepest part of the time decay curve, so every day actually means something. Every day is beneficial to you. The right amount of time to sell is absolutely huge. So where do we sell? That's the other big question. So just very basically, we sell your call spreads above resistance, hopefully above several layers of resistance. Sell your put spreads below support for the amount of time you have left. So for the time period that you're talking about. So let's just take a look here. So this is a trade we recently did on NVIDIA. And what happened, if you followed NVIDIA just a little while ago, they released their earnings. And even though they were absolutely incredible, they were fantastic, they didn't quite meet the whisper numbers. And so the stock sold off. So the stock initially dropped, popped up a little bit, sold off, sold again big, and it went down to this fairly strong level of horizontal support. So you'll notice that. You'll also notice that it bounced off a level of uptrending support. So now you're selling below 2 levels of support. And we drop down here and we find a minor level of support down here, and we're selling below all 3 levels of support. So this is kind of what you want for your ideal trade. You want to sell either, your calls, your put spreads below several levels of support. You want to sell your call spreads above several levels of support. And it's also really helpful to have an overall trend that's going in your favor away from your sold strikes. And also, you want to have the fundamentals on your side. So this is a situation where NVIDIA has incredible fundamentals. They're excellent. And the stock sold off for a really stupid reason. People are taking profits. The earnings weren't quite as incredible as somebody thought they should have been. But you can see very quickly it bounces, and then it's been moving right up this line. That just gives us a total green light to sell this spread with a really, really high probability of winning. So what do we base this on? So this is the Black-Scholes options pricing model. This is the pricing model that won the Nobel Prize in 1997 for the mathematicians that created it, 3 mathematicians. And it really tells us how to price options. It made the modern options market possible back in 1973. So what we're going to do is we're going to use this options pricing model to make sure that we always have at least an 80% chance of winning on every trade, an 80% probability. And we really place those trades really more between 80 and 90%. So we want to have a huge expectation of winning. And we really want this Nobel Prize winning formula in our favor. Now the problem is most of us aren't mathematicians. Well, the good news about this formula is you can use it to make money even if you don't know a single thing about the math. And I'll show you how. We're going to make this really simple. So here's an example of, we just recently sold a put spread on the SPX. And the reason is the XPX had a horizontal wedge going. There's another much, much longer term line coming up here. And on these horizontal wedges, you have sort of a compression of the spring. And what that tells us is that market is getting ready to break out one way or the other. So a little while back, about last week or so, we saw a breakout above this downtrend line on pretty decent volume. And much of the time it comes back down to test that support line and then bounces back off of it. And that's exactly what we've seen. Well, this is a very bullish breakout. And the commentary here is the actual commentary. I just took this chart directly from our subscription service. This is exactly what our subscribers see. I show you why we're taking the trade. I show you a picture of the trade. I give you a lot of commentary on it. I tell you where our stops are going to be. I don't leave anything to chance. I really want you to know exactly what to do when you do these trades. And the reason is I obviously want us all to win, and I want us to have as high a probability as we can while still collecting some decent money. So here we sold a put spread down here. We sold it, there's a nice level of support here. There's a downtrending level of support here. There's some minor support in here, about 26.80 or so, and we sold way down here at 26.65. So here's the question. How do you know, based on that Black-Scholes options pricing model, based on the math, how do you know you have an over an 80% chance of winning? Well, most of the traders I know, and me in particular, and the brokerage I recommend is Thinkorswim. So the reason, Thinkorswim has a lot of really, really nice features and attributes. But one of the things they do is and I show you how to do this, is up at the top here where it shows your options chain, it gives you a chance to click a little drop-down box and tell them what you want in these columns. So for selling spreads, I want implied volatility, probability of out of the money, and the delta. So the probability of out of the money really tells you your probability of winning. So in this particular case, we sold the 26.65 puts. We bought the 26.60 puts to hedge. So this is a $5 spread. And I've just zoomed in here and taken a picture, and the math, the Black-Scholes options pricing formula, is telling us we have an 80.94% chance of winning on this trade the minute we make it. So that's about an 81% chance of winning. So that's pretty huge. I mean, if you could go out and flip a coin with a buddy and have over an 80% chance of winning on every single coin flip, and every time you flip that coin, you got $1,000, I think you'd be flipping that coin until you couldn't even see the thing anymore. This is a huge probability, and I just want to point something out. This is just the straight mathematical probability. I mean, the formula doesn't know anything about the chart. The formula doesn't know that the SPX just did a breakout of major resistance just a few days ago on good volume. The formula doesn't know that it retraced back down to that support and bounced off of it. We have every technical indicator known telling us that the SPX is probably going to stay above those support levels and probably climb higher. So it gives us a total green light to sell a put spread well below several layers of support, and we have an 81% chance of winning just based on the math. But if you throw in the chart, which the mathematical formula can't see and doesn't know anything about, your chances of winning, your probability of winning, go up even higher. And I'll tell you, once you start winning on the vast majority of your trades, you're probably not going to go back to the super speculative trading again, especially with the majority of your account. So let's take a look at volatility. How can we use volatility to our advantage? Well, we're going to sell credit spreads in times of high volatility, transitioning into low volatility. So here's the important thing about volatility. Volatility determines time value. So collapsing volatility, this is a really interesting concept. Another thing you might want to write down. This is really cool. Collapsing volatility synthetically shortens the time to expiration in terms of value of the option. Let me give you an example. So let's say a company's going to announce earnings. It's one of the big companies everybody's watching. Maybe it's Netflix, maybe it's Google, maybe it's Apple, whoever it happens to be. You take a look at those options right before they announce earnings, and they are so juiced with volatility you couldn't even afford to buy one. They're just absolutely huge. And let's say that there's 2 weeks left until expiration. Okay, so the day before they announce, say they're announcing that night. The day before they announce, the options are just absolutely huge. Just absolutely bloated, super, super expensive. A lot of very high volatility is packed into the pricing of those options. Then they announce they announce earnings that night. The next day, there's a little bit of volatility. The thing shoots up one way or another, and then it kind of stabilizes about where it's going to be. One day after earnings, you'll see those exact same options practically worthless. All the volatility is just like the air being let out of a balloon. And you took an option with 2 weeks of time on it, say it was priced at $15, and one day later, with just 2 weeks minus 1 day, almost the same amount of time, that same option is worth $3. So that's almost like one way to look at it is it's like somebody sped up time. The day before it had 2 weeks of time on it, now it's got 2 days left on it in terms of the amount of time value priced into those options. So it's kind of a cool thing, because if you know how to work volatility, you can synthetically shorten the time to expiration. Literally. Because if you sold that option for $15, you can literally buy it back a day later for $3 and collect all that premium without even having to go to expiration. It's very, very cool. So one of the great things about high volatility is it doesn't last too long, as this chart of the VIX shows. So if you're a little bit of a student of volatility, I mean, take a look at this. Take a look at this huge peak here. Only lasted 3 days. This peak here lasted 2 days. Look at all this time here where the market is complacent, where it's just bouncing along. So for our purposes here on the VIX, let's just say this is 12. Below 12 in this particular chart is low volatility. Above 12 is high volatility. This lasted 2 days before it collapsed. This lasted about 3 days. You can just see it just doesn't last long. This lasted 1 day. Not long at all. So when you see high volatility, when you see a lot of volatility priced in, that gives you a tremendous opportunity to sell outside of the projected range of whatever you're talking about. This happens to be the volatility index on the SPX, but every option, that's the S&P 500, but every option or every stock has its own volatility profile. So when you see the volatility fairly high as a percentage of its historic volatility, that's a really good opportunity to sell outside the range, the projected range of the stock. It's a great way to collect a lot of money very, very quickly and have a chance to buy it back in the not too distant future for a lot less. So now we know how to use time to our advantage by selling on the right part of the time decay curve. We know where to sell our strikes, and we know how volatility affects the time value of our options. So how do we put it all together to create $1,000 paydays on any given Friday by risking just $1,500 and having over an 80% chance of winning to boot? So let's take a look at some actual trades, see how kind of straightforward these are to set up and how worry-free and hands-free they are, and see if this might be something that really appeals to you. So here we have the SPX, and this is a trade we just took a look at. In this case, for this particular spread, we collected 85 cents or $850 on 10 contracts. And to protect ourselves, we set up a stop right at our sold strike. Now, this is really important. I want to point this out to you. So we set our stop in this case right here. In other words, if the SPX gets down to this point right here before expiration, we're going to automatically close this trade. So once again, we don't have to watch it constantly. We don't have to try and figure out when the perfect time to exit is. And by the way, I just want to point out that this is the last time to exit this trade. You could also exit it if perhaps the support was broken or some other major support was broken. But the last time to exit, the worst case scenario, is closing right at the sold strike. So take a look down here. Option theory tells us that if we close right at the sold strike, the delta will be 1/2 of the spread. In other words, right at the money, the delta is 50. So that's 1/2 of the spread, or instead of costing $5 to close, it costs $2.50. So on a 10 contract position, that's $2,500. But keep in mind, we already collected $850. So we subtract that from the $2,500, and now we're making $850 by risking just $1,650. So do you see where the $1,650 comes from? We'll just take a look at it in a little bit more detail, but basically you subtract your credit, and then that gives you your actual risk. So let's just take a look at a breakdown of that. So we brought in a credit of 85 cents. So on 10 contracts, that's $850. The margin hold is $4.15. So that's what they're holding aside in our account until we either exit that trade or expiration comes along. But we're not going to ever risk this whole $4.15. We don't want to do that. That's too much money to risk. So we set a stop right at our sold strike, and our real risk is $250. So we subtract our credit from our real risk, so our 85 cents, and that gives us an actual risk of $1.65. So on a 10 contract position, if you're making $850 and risking $1,650, that's a 51% return. Now, based on the entire margin, It's just a 20% return, which is still fantastic for, 9 days of time. If you do that consistently, you're going to be rich. But if you base it on our real risk, the actual amount of money we're actually risking, it's a 51% return. So, we're pretty close to getting 1,000 for 1,500, but we're not quite there yet. In this case, we got 850 for 1,650. So let's take a look and see if we can improve that a little bit. What can we do to make that better? So here's another trade. So this is on the SPX. This is a little while back. We sold the 2440 puts when the SPX dropped down here to support at 2550. We figured it was going to start to rebound. It did. We sold a put spread and we took in 90 cents. So we took in 90 cents on a $5 spread. That's a $4.10 margin. So that gives us a 21% return all by itself based on margin. So it came down here. Let me get on our pen again. So it came down here. We sold the put spread, and then it immediately started climbing back up. It topped out and reversed, and that gave us the green light to sell a call spread. So for those of you that are into selling credit spreads, you know that this is a condor. So this is one of your wings, and this is the other wing up here. But here's the difference. I never put on a condor all at once. You put on a condor at the best time. So you take a look at the range of where this index or the stock is likely to trade. You sell below the range on the put spread when the index is down close to that. And then once it climbs back up and gets close to the top end of its range, you can sell your other wing and take in more money. In this case, we took in 90 cents on the dip, on the put spread, and we took in 70 cents on the call spread. And once again, it reversed and came back down. So let's see how this worked out. Let's see what we're doing here. Okay. So once again, we sold this spread here, took in 90 cents. When the index climbed up and then reversed and started heading lower, we sold our second wing for 70 cents. So that's a total of $1.60 if you add those two together. And then it came back down again and it retested the support level at 25.50, and we closed our top spread for 5 cents because we want to remove all of our risk. It's a good thing we did because it started rebounding straight back up again. So we originally took in 90 cents, then we collected 70 cents, then we closed for 5 cents. So this is $1.60 minus 5 gives us $1.55. So what we took in on these two spreads is $1.55 for just 7 trading days. What made this possible is the volatility. When the index is dropping, the volatility is high, so we collect a large amount of money for this put spread. When the index rebounds and is heading straight back up again, we collect a large amount of money for this call spread. So the volatility really helps us out here. So in 10 contracts, we took in $1,550. But what's our risk? Once again, to limit our losses, we set a stop loss right at our sold strike. So that's $250 on a $5 spread or $2,500 on 10 contracts. So our credit is $1,550. But if we subtract that from the $2,500, it comes to $950 in risk. So take a look at this. So if you think back to the title of this presentation, we're trying to bring in $1,000 on $1,500 in risk. But in this particular case, we brought in $1,550 on $950 in risk. We've actually completely reversed that whole equation. We're bringing in far more than what we're risking, and we're having over an 80% chance of winning on these trades. So we made substantially more than 1,000, and less than 1,500 by correctly timing our spreads. Now, this is a particularly good situation. I just want to show you what's possible with spreads because a lot of people think spreads are boring or they're low return, or they don't want to do them. And I'm kind of thinking, why would you ever want to buy an option when you can sell one and put both volatility collapse and time decay massively in your favor? So this is sort of a new way to look at options that might be different than what you've done before. And I just want to put across here that credit spreads are actually darn exciting. So here's the math on this. We brought in $1.55. Our margin risk then is $3.45. But when we set a stop at our sold strike, it's actually $2.50. So we subtract our credit from the $2.50, and our actual risk is $95. So on a 10 contract position, you're bringing in $15.50 and a risk $9.50. That's a whopping 163% return on a trade that you have a massive probability of winning. I think that's huge. And if nobody showed you this on credit spreads before, hopefully it's a pretty big eye-opener and maybe a reason that you could, should start trading this way. So what's typical? So, that's great. If you can do a condor and you can time it correctly, you can make a huge amount of money. But what's typical? And let's just take a look and see if typical is still pretty darn good. So this recent NVIDIA trade is typical. We're shooting for a 50-cent credit on a 250 spread. On a $5 spread, we might be shooting for $1. So in this case, that's a potential 50-cent profit on a $2 margin hold or 25%. So we're always shooting for about 25% return. Maybe between 20 and 25, but we'd really like to get 25%. But here's the thing. You have to figure in cash and buybacks. So you're not trading your entire account all at one time. So you're going to set a little bit of money aside for buybacks. You're going to set some money aside for, margin holds or rolls or certain things, certain adjustments that you might want to make a trade better. And so let's just figure you're setting aside a certain amount of cash in your account so you're not getting these returns, this 25% on your whole account. And we also have to realistically, figure in, a couple losses here and there. So, if we have an 80% chance of winning, that tells us we're going to win about 80% of the time. We're going to lose money or have to close out our trade about 20% of the time. That's usually automatic, so there's, very little stress involved there. It just happens. But we have to figure in those losses and figure that they're going to reduce our return a little bit. So I see a lot of people, typically making, kind of a fairly easy, steady 10 to 15% every time they turn their money, or in this case, every 2 weeks. But I want to cut this down really, really far. I want to cut it down so low that it's at a level where you feel like, man, even if you're inexperienced, even if you don't click the mouse at the perfect time, you can still make at least this rate of return. So I want to cut this all the way down to 5%. But keep something in mind. You're doing this every 2 weeks, and you're compounding your money. So you're making money on your money. You're making money on your profits. So whatever you made the last 2 weeks, you can use that now to trade in this cycle. So let's see what that looks like, starting with just a $10,000 account over time. So, we're keeping in mind our parameters here. We're shooting for 25%. We usually get it. Most of these trades work out in our favor, but just figuring in a loss and holding cash aside in your account, figure all you can do is 5% every 2 weeks. What does that look like? Well, here's the graph. And mathematically, after 2 years, your $10,000 has grown to $104,000, and you're bringing in over $10,000 a month. And this is 2-week periods, and you can see what happens here. It kind of starts out, it's just how the math works. It's how compounding works. It starts out fairly modestly here in the beginning, and towards the end, it's just going up exponentially. And if you think this is unrealistic or you think this is crazy, I know money managers where all they're doing is credit spreads, and they're doing huge amounts of money. And even though they're super conservative, maybe more conservative than we are, their accounts still grow in just an amazing fashion. So I just want you to see this graph so you can kind of see what the potential is. And if in your trading you've been kind of doing this 1 step forward and 2 steps backwards, you're just struggling to master it, and that last trade almost worked out and it didn't quite. My suggestion is really stack the probabilities in your favor and see how that doesn't just change everything, how you can start winning in spite of yourself. So, my question is I've been doing this for a long time. We've gotten really, really good at it. I'm really good friends with most of our subscribers. We correspond. And the reason things are going so well is because we just win most of the time. And when people see their accounts grow, and when they see things improving, and they're able to take that money out and really improve their lifestyles, it puts people in a good mood, especially if they've struggled for a long time trading and not really being able to make it work. So my question to you is would you like to bring in these kinds of credits and these kind of returns with my help, especially when you consider your high probability of winning and the short hold time until expiration? And listen, if you're doing something else out there that's really thrilling and exciting, some form of trading that you really like, go ahead and keep doing it. But do it with maybe 10 or 20% of your account and take the vast majority and do something where you're just naturally going to win the majority of the time. So even if the timetable doesn't work out perfectly like on the graph, and of course they never do, there's always ups and downs. It's usually a jagged line. Some months you'll do better, some months you won't do as well. But even if it doesn't work out just like on the graph, what if it even comes close? And look at what you've learned. How to make money from anywhere in the world you can get an internet connection. That's freedom. And that's worth everything. So the key to making this work is knowledge and having the confidence to really know what you're doing. So I put together a program it's the best out there. I've looked at everybody else's work, and most people will just give you a tape set or something to listen to, maybe a little bit of written material, but I want you to see how complete this is. And the reason is it's super important to me that you're successful with the strategy, so I want to make sure you've got everything you need to do really, really well, even if you've never done it before. So the first thing is the winning secret training package, and you'll see how wide of a spread to sell, how much time to sell, what to do if the stock starts getting too close to your spread, how many spreads to have on at one time, plus a big section on adjustments. Everything you need to trade this strategy with confidence. So let's just take a look at what's in that. You get a 161-page downloadable ebook complete with charts, graphs, pictures, everything you need to start trading profitably and stay that way. Plus, you get a multi-chapter video series where you can hear and see exactly what to do to start generating this income. Very instructive, and even if you haven't had a lot of experience, I take you right from the very beginning, what an option is, how to trade, what the characteristics are, what to watch out for, how to really put the characteristics of options in your favor so you have them working for you instead of against you. You'll also gain access to our archived webinars, and there's some incredible information there on money management, how much to allocate to each trade, really how to run your account so you can discover new strategies and ways to improve your returns and reduce your risk. You'll also have access to all new webinars for life as an owner of this package. So one of the points that I want to make is this isn't some static piece of information. This is a growing, collection of teaching information, new strategies that you have access to forever once you become a member. So this is the educational part of our site, and once you join us, you never have to pay anything more, never anything extra. You have this forever. And I really love that, and I love the way that it improves and keeps getting better. Plus, I've got a whole series here. There's 3 videos that show you how to set up automatic orders with our favorite broker for spread trading. These are the videos that show you how to automate your trades so you don't have to constantly monitor them, providing peace of mind knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. So the coolest thing about this is really the lifestyle. You make the money, but you're not having to be glued to your computer. You don't have to be some super Johnny-on-the-spot day trader. You can actually go out and enjoy your life and still bring in quite a bit of money. I have a lot of retired people that do this. The folks that really love the strategy are people that understand numbers, like retired engineers, math teachers, accountants. I've got a chemist out in Chicago. People that know numbers love this. So this is the part that I'm really proud of, and this is really fun. This is where you and I take you by the hand, and then we go out into the market and we find trades, and we put them on. Once again, I tell you exactly what to do. Now, this is our subscription service, and I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. And this is broken up into 4 parts. This comes out every Tuesday evening, comes out late, but no matter where you live, you'll always have it available to you Wednesday morning before the market opens. And I talk real quickly here about how our trades did the last week, what we closed out of. Then we take a look at the S&P 500 and the most likely direction for it. You can see a picture of which way the market's heading. Then we do some really good analysis down here about the market, the factors that are driving it, and which way it's likely to go. We've gotten very good at this. Then I offer you 2 trades for that week. So one of them is more conservative. It's really good for a Roth IRA or a retirement account. It's the kind of trade you can depend on. That's typically on the SPX. Well, once again, we've gotten very good at trading the SPX. And then the next one will be a more aggressive trade, and that'll be on usually a stock or another index. And that'll usually give you a little bit better return. But I just, I explain everything. I explain, where to get out, where to get in, what the minimum credit is, the factors driving the trade, the things to watch out for. And then if there's something that comes up in the middle of the week or something that we need to do, I'll send you out an email immediately. And if you want, we've even got a facility there on our site for you to give us your phone number, and we'll text you. If a trade needs to be adjusted, we need to get out of something. What if there's a really cool opportunity that pops up? You'll get a text that say, hey, the market just moved, just broke out. We have a great opportunity on a put spread here. Let's take advantage of it. So you really get some pretty incredible service. Now, this is $97 a month, but I don't think you're ever going to have to worry about that past your first month, because the whole idea is for the market to pay for your subscription so you don't have to. So one of the things that I'm doing in this package, since I don't want to really to pay for anything, I want the market to pay for it, I'm including your first month with the package. And so your first couple of trades, can easily pay for your subscription. So I don't want there to really be any money out of your pocket. I want the market to pay for this. The other thing that we've created, I want to throw in a bonus here, and this is how to trade the weeklies for maximum gains with minimum risk. So this is a 10-module video course and digital book, and it's probably the most popular thing that we've ever created. People love this thing all by itself. The weeklies have completely changed options. They've made it so much better for us, and they have some different characteristics, and there's some different ways to trade them. So I think you'll really enjoy that. And that's an extra. It's an extra I'm throwing into this package here. The other thing is our brokers. So we love Thinkorswim. I know there's other brokers out there. I've tried just about all of them. They're the best broker. If you look at most options traders, even the pros that are using Thinkorswim, they have really good analytics. One of my favorite things about them is they can get you filled inside the spread, which is huge. That can make you a lot of money right there. And if you're a beginner at this, we work with a team at Thinkorswim to give you special commission rates to get you started, so that the commissions don't eat too much of your winnings in the beginning if you're trading just 1 or 2 contracts. So once you sign up, we'll get you in touch with our special team, and you can request these rates that we've got approved for you. They can really help you get going in the beginning, and even after you get, start trading more contracts, Thinkorswim can switch you to an even better rate for that. But we want you to have a chance to make money in the beginning. So this is kind of a really big boom for becoming a subscriber. The other thing is I want you to have some one-on-one attention. A lot of the time what people do is they'll subscribe to a service. They don't really know what to do. They don't know how to make their first trade. They don't know how to get into it, and so they just don't take action. And so I've got someone on my staff that's really, really good at this. They're going to walk you through the website, show you how to read the newsletter, show you how to place your first trade. They'll show you how to open an account at Thinkorswim if you're not familiar with that. They'll spend some time with you and really walk you through all the benefits, everything you have available to you, and they won't get off the phone with you until you really understand what's going on and you're comfortable with it. And we get a lot of feedback. Here's a little, testimonial down at the bottom, people that really like this personal guidance. Once again, I don't know anyone that does that, who has the time or the resources to really spend some time with you one-on-one. And towards that end, we've got an incredible mentor. We have a mentoring program that you can sign up with, to get one-on-one attention. But I want you to get your first session for free. I'm including that in this package too. And it's a 45-minute session. We've got a professor. He's got a doctorate in finance. He's incredible. He's incredibly bright, but he's down to earth. He's humble. He's really good at explaining things. He's a professor at 2 different colleges. He teaches online. He actually teaches finance classes at Purdue, but his real passion in life, what he really loves is trading. Trades options, loves spreads, trades futures, loves the seasonality of the market. He can show you some incredible things, and I want you to have at least one session with him on me. I want to throw this in and see how wonderful it is to have somebody out there with you, showing you how to find a really good trade and how to make money. Most places, this is 5,000, 7,000, 10,000. I want you to get this, and I want to include it. I want to show you how cool this is and see how much money you can make with some really good guidance. So in short, this is a trade you can't afford to miss. You don't want to miss it. I've got an incredible package here. I used to sell this on international live events. I've sold it on cruise ships for up to $2,500. Still get emails from those people that are delighted. They're still cash flowing the markets. That was many years ago. But I've added so much to the package since then. I've added this individual guidance, added a lot of really great information here. It just kind of breaks it all down for you. You get the entire package. You get the subscription, for the first month. After the month, it just auto-renews. You get your one-session coaching here. You get the orientation. You get everything. And this price is, you're not going to believe it when you see it. It's incredibly reasonable. Anybody here that's listening can afford it. You get so much. And you can see the whole package. It's all broken down for you, and it's at 1000-payday.com. So $1,000payday.com. And, Jeanette, if I could get you to just post this as a link in there so people can click on it. I want you to be able to see the whole package. I want you to see everything that you're getting, and I want you to see the price. And this is something I kind of don't like to publish this because it's too darn low, and we don't even publish it on our website ever. The only way you can get this is if you're affiliated with somebody that we really like Jeanette and TradeThirsty. So I want you to go there. I want you to check it out. I want you to sign up. Obviously, we have a guarantee on the education, so there's no risk to you. But I think we're going to be together for a long time. This is a fairly simple way to trade. It's pretty straightforward, and we just tend to make money. There's few things more gratifying than watching your account grow, because it really gets your imagination going. You start thinking about, the lifestyle changes and the different things you can do with that money, and some of the things that you can finally do. You can travel. You can do this from everywhere. I've made trades from all over the world. So I appreciate you being here. And, we've got just a couple extra minutes because we started late here. So I would actually like to take some questions if people would like to ask some. So if you have some questions about our program, if you're a little unsure about some things, I would really like a chance to do that. So I have a question here. Can you cancel anytime? Yes, of course you can. You're not locked in. We don't sell you a year or whatever. You can buy that. We'll give you a big discount for buying a year. Most of the people that are with us for 2 or 3 months, they say, this is great. I want to buy a year, so they do. We even got quarterlies you can buy, but we start you off month to month so you can just see if it works for you. Let's see, what else? How is your program different from the previous speaker? Well, he does different strategies. We specialize in this, and I think, I can't speak for him, but we're very, very successful. I think I'm about the only one I know out there that actually publishes my trade record for the public to see. Nobody does that, and probably for good reason. So you can actually take a look at what we do. What's your actual returns per year? Our returns per year are kind of gigantic because we actually calculate our returns every 2 weeks. And we average, even with buybacks, with closes, with occasionally the market gets crazy and we have to close a trade out. We still average about 6-7% every 2 weeks. And if you calculate that out, you're gonna get rich if you do that. We have people that have been with us for the last 8, 9, 10 years. Trade records right on the public part of the site. Somebody asked how they can access it. Let me see. Let me get down here. Is $1,500 the minimum required to begin? Actually, we kind of recommend an account. You can do it with $1,500. You can try and trade one contract. We really recommend about an account of, let's say, $5,000 to make it easy. But you can start with less. I think the minimum to open an account at Thinkorswim is about $2,000. Okay, I'm reading a question here. Can this be a strategy implemented with results close to those stated end-of-day basis? It really can. So here's how we do this. I don't expect you to be super quick or get the best of the day or whatever. So I give a minimum credit that we are willing to accept. you can enter your orders before the market even opens. Sometimes I suggest that you watch the open to see what's kind of going on. But you can specify that minimum credit, and you will either get filled or we don't. If things are really good, a lot of the time we'll leg into spreads, and we might get better than the minimum. But you don't have to worry about being this super expert. And it says, can this strategy be implemented with results close to the stated at the end of the day basis? It's, I don't really know. That would be based on whatever the SPX closed at, which is a lot of the time different than where it fluctuates during the day. I just know that it's not difficult to get filled. We enter our automatic orders, we specify the minimum, and you just get filled. You don't have to watch it. You can be at work, you can be at anywhere. You just come home and you find out that you got filled on the trade. It says, Lawrence asks, won't one loss wipe out many wins? No. As you could see, if we're bringing in 1,000 and just with a one-sided trade, and our risk is only 1,500, it's only 1.5 trades to get back to break even. So you're probably thinking of the way other people trade credit spreads, where you get this tiny, tiny credit, and one loss can wipe out a lot of wins. That is not the case here. Do you put the stop loss on when you put on your spread? What we do is we wait till we're filled, and then we put the stop loss on. So you just check, see if you got filled, and then put your stop on. And sometimes we put it at the sold strike. Sometimes we put it if a certain resistance or support level is broken. Let's see. Will the UK will toss accept me? I don't think Thinkorswim is open in the United Kingdom. I think they have trading in Australia and in Canada. In the United Kingdom, you're probably going to want to go with interactive brokers, and you can actually do the same strategies and follow along with us there. Do you let your spread expire? Do you exit a few days before expiration? In a lot of cases, if we're a long ways away and we're close to expiration, we just let it expire. However, we kind of have a rule, and that is if we collect 90 cents or $1 on a spread, and it gets down to 5 cents, the SPX gets down to where that option is worth 5 cents, we just close it. Why not? Why not close it for a nickel? Remove all that risk, and then and you get all your money back to trade again. Are there better days of the week to trade? We do this kind of uniformly. We trade. We come out with our update on Tuesday night. We place our trades Wednesday morning, and we tend to get filled that same day or the next day, and that seems to work out really well. Another question is, do you advise when to put your stop in once filled and where to put the stop? Absolutely, we do. And we put a stop at wherever the index or stock happens to be. And then that turns into a market order. And how many maintenance dollars you need to execute a spread? So that's just the opposite of what you took in. So if you took in $1, they'll hold the whole $5, but you also got the $1. So the net hold is really $4. I'm on vacation in June. No computer. Can I start in July? Yes, actually you can. So that's a good question. Summer months, a lot of people are vacationing. So one of the things that you can do is sign up now. And then, you can go over the education at your leisure. Even if you're on vacation, you can just take a look or listen to a video or whatever, and then tell us that you don't want your subscription to start for a month, and we can put it on hold for you and not start until then. Do you recommend writing spreads on options that expire 2 to 4 months out since the time decay is not that great? No, we don't. Time decay is almost flat. Doesn't do you that much good. We really want to get on that steeper part of the time decay curve. And we also want regular paydays. So if you're writing 2 or 4 months out, that's really waiting too long to get your money. Let's see. It says you trade Wednesdays with the options expiring 2 weeks from that day. No, what we do is we trade Wednesdays with the options expiring the next Friday, so a week from that Friday. So it turns out to be about 9 calendar days and really about 7 or 8 trading days is typically what we do. So it looks like we're just about out of time. I really encourage you to go there. I'm going to actually tell you the price. I want you to go, but it's $397. Think about that. That includes a live orientation. It includes a live coaching session, which is usually $395 all by itself. And it includes your first month of the service, which is $99 all by itself. So go ahead and get signed up. I think you're going to be glad you did. I really am looking forward to having you on board. And I just want to say thank Jeanette and TradeThirsty for having us. I'm looking forward to working with you. I'm looking forward to making some money together.